A way that you can really make money and beat the index, in our view, and it's proven out throughout history, is to buy unloved companies. And as long as you get comfortable with the bits that the market doesn't like, then you can position yourself quite well. So with APN, about 12 months ago, they had balance sheet issues, and that's a clear consideration. Whenever you're looking at a company, you want to make sure they're not going to go out of business, and a stretched balance sheet is about the surest way you'll find of a company going out of business if they can't raise capital and and repair it. So with APN, they had a stretched balance sheet, but they had a strategy of selling assets, and they had some very good assets. So they had outdoor advertising, which they sold 50% off, and they've since sold the remainder of that off. And that basically, that sale alone really went a long way to repairing that balance sheet. And so what you get, so if you're looking at businesses and they've got a stretched balance sheet, what you either want to see is a capital raising, and if that capital raising is being used to repair the balance sheet, then quite often the investors get a double benefit of, first of all, being able to buy a stock at a discount to raise the money, and then once the money's raised, the balance sheet risk is off the table, and there is normally a PE re-rating, because and that's just it. And you saw it during the GFC. A lot of businesses were raising money, and investors have done very, very well by participating in that. So that's one strategy I think that investors could be cognizant of. And the second one is look at the quality of the assets. So if the company has a number of different assets, they could potentially sell one or two. With Fairfax, we saw they sold Trade Me. With APN, they sold their outdoor advertising business. Both of those events had significant, gave a significant uplift to both of those companies, notwithstanding the fact that they've still both got significant exposure to print media. But comparing Fairfax with APN, for instance, Fairfax are on 16 times earnings, but they've got Domain, which is a terrific business. APN are still only on about 9 times earnings. They were on 3.5 times earnings. So between those two, APN looks like better value. They've got very good radio assets, but 50% of their revenue still comes from print, which is the perceived risk.
Okay. Now, last question before we wrap it up. We talked about half a dozen or so media stocks. At the start, APN, 9, 10, Prime, 7 West and Fairfax.
Yep.
If you had to buy one or put one into a portfolio today, which one would it be now?
All right. Well, I think content is key, and 7 West Media are the clear dominant player in that. So 7 West Media generates about 70% of its earnings from Channel 7, and the remainder broadly comes just from Western Australia newspapers. So if you want a good liquid company that you can buy, knowing that they've got the market dominance in content, and they've also just done the deal to distribute 2 of the next Summer Olympics and 1 Winter Olympics. So they've got that content. They've got the AFL as well. So that's 7. If you want a little bit more of a liquid play, Prime TV distribute 7 content to regional areas. So it's called the media reach rule, which is being debated now, but the media reach rule states that one media outlet can't distribute content to 100% of the population, and so 75% is the maximum they can distribute to. So for 7, they distribute to the metro audience, and they've got Prime to distribute to regional areas. Or with Channel 10, they've got Southern Cross Media, and so there are all these regional stations that so Prime is a pure TV, free-to-air TV distributor. So there, if you're looking just for that pure play, then Prime's probably a bit better. The other thing is that Turnbull's talking about relaxing media reach rules, and if that occurs, and it looks like it will, these regional networks will come into play as far as takeover targets are concerned. So I think they're the 2 that I like. They're both on about 10 or 11 times earnings. Both have a similar yield of about 10% once you gross it up for franking. If you're comfortable with the fact that free-to-air TV isn't going anywhere, and the audience can ask themselves how much free-to-air TV do they watch, and then if they think that that's an ongoing theme, if they do watch it, if they don't, then they can probably make their own decision on that.